Are you trying to grow a rental portfolio but keep getting stuck because your tax returns or W-2 income don't look perfect to traditional banks? In this video, we're breaking down DSCR loans, the complete beginner's guide, so you can understand how to qualify based on the property's income instead of your own. Stick around, because by the end you'll know what DSCR loans are, how to calculate DSCR, common lender requirements, how to avoid rookie mistakes, and you'll see several real-world style examples you can copy for your own deals. Welcome back to the channel, where we talk about real estate investing, financing, and building long-term wealth. If you're new here, consider subscribing and hitting the notification bell so you don't miss future videos about rental loans, creative financing, and step-by-step deal breakdowns. A DSCR loan is an investment property loan where the lender mainly cares about whether the property's cash flow can support the loan payments instead of focusing on your personal income. DSCR stands for Debt Service Coverage Ratio. It compares the property's net operating income, or NOI, to the annual debt service, which is just your yearly principal and interest payments. You'll typically see DSCR loans used for long-term rentals like single-family homes, condos, and townhomes, small multifamily properties like duplexes, triplexes, and fourplexes, some short-term or mid-term rentals depending on the lender, and occasionally mixed-use properties with strong, predictable income. These loans are especially popular with investors who are self-employed or who take a lot of write-offs on their tax returns, because their taxable income looks low even if their real cash flow is strong. Most investors start with conventional loans that look heavily at your W-2 income, tax returns and pay stubs, and your overall debt-to-income ratio. As you build a portfolio, your reported income often shrinks because of write-offs. Your DTI rises with each new mortgage, and you can hit limits on how many financed properties a conventional lender will allow. DSCR loans solve that by shifting focus from you to the deal. So the key question becomes, does this property generate enough income to comfortably cover its mortgage payments and operating expenses? Here is the core formula you'll hear again and again. DSCR equals net operating income divided by total annual debt service. Net operating income is the property's income minus operating expenses before mortgage payments. Income might include rent, pet fees, parking, storage, or other charges. Expenses usually include taxes, insurance, repairs, utilities you pay, property management, HOA fees, and a vacancy allowance. Mortgage payments are not part of NOI. Total annual debt service is the total of all yearly mortgage principal and interest payments on that property. A DSCR of 1 means the property brings in just enough NOI to cover the loan payments. Above 1 means there is a cushion. For example, 1.25 means 25% more income than needed to cover the debt. Below 1 means the income is not enough, on paper, to fully cover the loan payments. Most DSCR lenders like to see a minimum DSCR around 1.2, 1.25, although some may allow lower if you put more money down or have excellent credit. Let's start with a simple example so the math actually sticks. Assume annual rent is $24,000. Annual operating expenses are $6,000, and annual mortgage payments principal plus interest are $14,000. Step 1. NOI equals $24,000. $6,000 equals $18,000. Step 2. DSCR equals $18,000 divided by $14,000 is approximately equal to 1.29. This property has a DSCR of about 1.29, which means it brings in roughly 29% more NOI than needed to pay the mortgage, and many DSCR lenders would see that as a solid cash flow cushion. Here is what a typical DSCR loan process looks like. First, you find a property you want to buy or refinance, maybe a single-family rental, maybe a small multifamily. Second, you provide income data. If it is already rented, you give the lender the leases and a rent roll. If it is vacant or a new purchase, they may use a market rent estimate, often backed by an appraiser's rent schedule or local rent comps. Third, the lender estimates NOI by looking at the expected rent and subtracting typical expenses like taxes, insurance, and a standard percentage for vacancy and management. Fourth, they structure the loan amount, interest rate, and term, which gives a projected monthly payment and therefore your annual debt service. Fifth, they calculate DSCR using the formula and check if it meets their minimum requirement. Sixth, They underwrite you and the property, checking your credit and reserves, and verifying value, condition, and allowed property type. Finally, if everything lines up, you bring your down payment and closing costs, sign, and close. The property becomes part of your rental portfolio. A big selling point is that many DSCR lenders do not require tax returns or detailed income documentation, which can make everything faster. Typical DSCR lender requirements include a minimum DSCR around 1.2, 1.25 for standard pricing, with lower DSCR often meaning lower maximum LTV or higher rates. Many lenders want to see at least mid-600 Science credit scores, and better scores can get better pricing. Down payments are often 20–25% for investment properties, sometimes more for riskier situations. On property type, some lenders focus on 1–4 units. Others allow small apartments or specific short-term rental markets. And there may be restrictions on rural areas, condos, and properties in poor condition. You may also need reserves, such as several months of mortgage payments in your accounts after closing. Now, why are DSCR loans so popular? First, they focus on the deal, not your W-2. If you are self-employed, semi-retired, or aggressive with write-offs, this is huge because the property's numbers matter more than your tax return income. Second, they usually require less income documentation, often no tax returns, no pay stubs, and no employment verification. Third, underwriting tends to be faster and simpler, which helps you close sooner in competitive markets. Fourth, they can make it easier to scale because lenders are looking at each property's DSCR instead of a strict global DTI. And finally, they tend to be entity-friendly, allowing you to borrow in an LLC or corporation. But there are trade-offs. DSCR loans usually have higher interest rates than owner-occupied conventional loans. You might see higher fees and points that push up closing costs. Down payments are typically larger, often 20–25% or more. Many DSCR loans include prepayment penalties if you refinance or pay off the loan early, especially in the first 3 to 5 years. And there can be tighter rules on what kinds of properties and locations they'll finance, especially with certain short-term rental strategies. That's why it's crucial to read your loan estimate and final documents carefully. Ask very clearly about prepayment penalties and whether your rate is fixed or adjustable, and stress test your deal for rent drops and expense increases. Let's lock in what this looks like with a few more examples. Example A, a strong DSCR, annual rent $36,000, operating expenses $10,000, annual mortgage payments $18,000. Nois 36 000 10 000 égale 26 000. DSCR is 26 000 divisé par 18 000 environ égal à 1,44. A DSCR of about 1.44 shows a strong cash flow cushion, and many lenders will like this deal. Example B, a borderline DSCR. Annual rent $24,000, operating expenses $8,000, annual mortgage payments $16,000. Noi is kaksikumentannelia, nolla, 8 nolla, I, 16 nolla. DSCR is 16 0 16 0 alka 1. At 1, the property breaks even on IPR, so many DSCR lenders will see it as too tight, decline or reduce the loan amount. Example C, improving DSCR. Start with example B, but lower the annual mortgage payment from $16,000 to $13,000 by putting more money down or adjusting terms. NOI stays $16,000. DSCR becomes $16,000. $13,000 is approximately equal to 1.23, which might now meet a lender's minimum and shows how down payment, interest rate, and term directly affect approval. DSCR loans tend to be a great fit if you're a real estate investor focused on long-term rentals or some stable short-term rentals, if you're self-employed, or a business owner whose tax returns don't tell the whole story, and if you want to scale beyond conventional DTI rules and property count limits. They're usually not ideal for primary residences, for properties where the rents are clearly too low to support the payments, or for borrowers who are uncomfortable with higher rates, larger down payments, or prepayment penalties. If you want to explore DSCR loans for your next deal, Here's a simple game plan. Pick your target, whether that's single-family rentals, duplexes, small multifamily, or a specific short-term rental market. Estimate realistic rents and expenses using rent comps or by talking with local property managers. Run the DSCR by calculating NOI and estimating the mortgage payment to see where you land. Talk to multiple DSCR lenders about their minimum DSCR, maximum LTV, credit score requirements, interest rates, fees, and prepayment penalties. Then compare the offers and stress test your numbers so the deal still works if rents soften or expenses go up. If you found this helpful, hit like, subscribe, and drop a comment with your biggest question about DSCR loans or real estate financing.